Good evening, ladies and gentlemen. Welcome back to another Stocks to Buy episode, late night, Sunday night, taking you through kind of the adventure over the last week and this narrative that actually hasn't really changed that much if you want outsized returns within your portfolio. Is there's actually a CNBC video we're going to break down that fully encapsulates this in a beautiful, discussed and kind of panel that breaks this down. We're going to talk about some of the energy sectors. We're going to get into obviously the AI sector when it comes to NVIDIA, but more importantly, I have a video that is more haunting of the future of AI than I think a lot of us were anticipating. That has to do with some comedians. If you didn't see that this week, it's absolutely mind-blowing. Maybe we discuss some Bitcoin and some other things in between here, but I do appreciate you all stopping in. If you are on your path to financial independence to perhaps one day retire early, as always, consider hitting that like button. Folks, before we get into the Q&A at the end of the show, we're going to break these down. I'd love to know what you think about this stuff, but my God, does this hit home on so many levels? And as a lot of you said, don't talk about Google's going to get mentioned too much in this video. I'm going to try not to mention Google, but there's going to be a larger at play conversation that I want to get into as we break this video down, but take a listen.
So what's your view of this market here?
So we're 7 trading days in, and you have to begin to ask yourself the question, okay, how long do you give it for the consensus to be right? How long do you give it? How long do you sit? Because last year I waited till April. This year I'm not waiting till April.
So far, year to date. I mean, you're going to give it 8 days? Or you're going to make up your mind after 7?
Well, you tell me. How do you respect what's going on in the marketplace right now? Do you respect the dominance of algorithms right now, in which the S&P equal weight, which was supposed to outperform, it's underperforming right now by 75 basis points. How about small caps? They're down 3% so far year to date. Mega caps, we were supposed to forget about mega caps. Guess what? You have a Mag 5. You know what they are. Exclude Tesla, exclude Apple. Don't run too far away from mega caps. And Scott, by the way, how's your energy equities doing? Because everyone loves them.
Not mine.
Fundamentally.
They're yours.
Oh, energy is going to be the sector in 2024.
Because he's got like 10 of them.
That's right. I do. I own it. 2.7% energy equities are the worst sector so far year to date. Why are they not being bought? Natural gas is up 20%. Spot price of oil is up 1%. How long do you give?
So what are you telling?
So look, I just want to break down a lot of the points that he mentioned here. There's a lot in this video I want to get back to, but just take a look at this kind of chart of year to date, kind of just comparing all the major indices. So you've got the S&P 500 versus the small caps, Vanguard Energy, the Qs, and you've got the S&P 500 equal weight, right? And it seems to be this continuation of the Qs, the NASDAQ, and the S&P that are just crushing basically all sectors, with an exception. The healthcare sector actually wasn't doing as bad, which they mentioned in there, but all these sectors just continue to kind of respond the same way that we've seen in the past. And there's a good reason for a lot of this. And I think people are over jumping the gun when it comes to the interest rate cycle. And I'm going to get more on the interest rate side of things in a little bit within this video. But I also think it's intriguing too, that if you take a look at, during the geopolitical event, how insanely expensive natural gas got. And if we kind of just zoom in over the last 6 months here, we can see we're starting to rebound a bit off a lot of the lows we were experiencing, and oil's coming back. But when we're talking about commodities, they're always very cyclical in nature, but there's one commodity that has not been cyclical. I've been talking to a lot of uranium explorers. That has got to be, the uranium. It is the new gold. It is the new rush. Outside of crypto, I think uranium has been on one of the hottest streaks that anyone could have ever imagined. And no one really discusses this sector, which I always find very intriguing. I'm not really trading this sector, but I'm always fascinated to figure out what the supply and demand metrics are of uranium, considering how much of it is already stored in capacity. A lot of uranium companies have huge reserves, just crazy, thousands of metric tons of uranium just laying around. And I'm just curious to what has been driving up the supply and demand. I've been hearing a lot of decommissioning of old, nuclear bombs that are being recycled for reactors and all kinds of stuff. But I've just never been able to wrap my head around why this sector is seeing such a supply and demand constraint. But nonetheless, let's just continue on here because there's great points in this.
Telling me that 2024 is going to be 2023 all over again. We're going to have
risk, isn't it?
We're going to have mega caps outperform everything else.
That's a big risk for portfolio managers. So no one is going to be able to sit here and say on January 10th, well, at the end of the year, I believe that this sector or this equity size class is going to be the one that outperforms. As the year evolves, you reshape your risk according to what the market's doing. And what I'm telling you is January 31st, Joe T ETF will rebalance. I am in a period right now where I cannot make any individual changes to personal.
So this is funny because he's talking about, his own, I guess this guy manages an ETF and he can't make personal changes based off that ETF. I mean, I'm sure there's some regulatory ideas around it that he's discussing right now.
Holdings of equities. I could do some options. I could do the QQQ, the SPY, but I'll tell you what.
So you could just get worked up and angry about it.
I'll tell you what, on January 31st, if this is the formation we have right now, I personally own Microsoft. That's not enough in the mega caps. I am personally going to have to buy some of the other mega caps, and it'll be consistent with what we do in the ETF.
Yeah, but what's going to be the pivot, though? What's going to be the pivot between the pivot for you to say, okay, it's time? Because last year the market
was already looking at that.
Well, I know this massive amount of PTSD last year, right? And then nobody trusted the rally. Like, this is just a BS rally. Nobody, well, you did because you're really smart. But the majority of institutional investors missed the rally until March, and that's when they got into tech. They didn't buy tech until March.
In April.
But it's just not. It's not just those five, though. I mean, you are seeing some rotation into some things that underperformed last year, and maybe it's more interest rate sensitivity. Maybe it's maybe that's why you're seeing utilities.
Utilities. Does that get you excited?
Healthcare is the best performing sector this year.
Healthcare is now.
Now, as she mentioned, I really want to focus on the sensitivity of interest rates because these sectors only started to perform well as soon as they mentioned that they're not going to be raising interest rates anymore because there was so much future prediction and pricing into the stocks of further interest rate hikes. So the stocks that she's talking about, those dividend specific stocks that so many people love, you're not going to see outsized performance in those until we start getting into an interest rate cut cycle, especially these heavy debted companies that are utilities, that are REITs. So these sectors, though people think that they're rallying great now, that's not going to last until we can start talking about interest rate cuts, right? So this is why tech continues to outperform because tech doesn't have the same balance sheet as so many of these other companies. They're not nearly as interest rate sensitive, right? And that's why this trend is kind of remaining the same. It's like we haven't got enough of a dramatic shift in the market yet, I think, to rocket to bring the lower half of the market up.
Get me excited.
Let me tell you something. If utilities are going to lead the way in 2024, we're going to have a bad year.
So
we're going to have an unexciting year.
What I would argue, though,
we're going to go like 2-16.
What I would argue is that there might be a perception, and I think it would be an inaccurate perception, that right now this short-term strength in those more defensive sectors is indicating that we're entering a period where we are setting up for a more bearish tilt. I think that's overstated. I think that there is just a little bit of rotation right now, looking at some of the laggards, taking some money off the table, and perhaps in those two names or the other four names that aren't participating along with these five, there could be a rotation. Right. So, but there are things that are doing well, Scott, that are outside of those five names.
But let's zero in on this a little bit more. This comes down to a debate, Carrie, over whether mega cap tech is too expensive or not. You come into this year, people say, well, valuations are too stretched, so therefore there's going to be a rotation into valuations that are more attractive and cheaper, right? Like some of the areas that we've already talked about, energy and healthcare, industrials and things of the like. RBC today downgrades tech to market weight from overweight. They say both valuations are now clearly expensive for the median stock in the sector on both an absolute and relative PE basis. This is where the debate begins and ends. Either these stocks are too expensive or they're not.
So I just want to talk about that really quickly when it comes to the valuation on these big tech companies, because that is kind of the discussion here. And for companies like Microsoft here, where we're trading at like a 37 times multiple, is really going to come down to what these next earnings look like. But there's something with Microsoft. And again, this isn't the most expensive. And you go back to the peak of 2021, it was trading around a 35 times multiple, but it was growing. So if we're getting back into a growth era, Microsoft can demand a higher multiple. It makes sense. These are software companies, and software, as we made in my last video, you look at the balance sheet of these companies, and they are damn near jaw-dropping and comparable to a lot of companies like Apple, right? Because Apple is manufacturing products. The same thing with Tesla. And these products are incredibly expensive, which means they come with, a consumer, sentiment in mind. Whereas with software, you need the software. The software has higher margins. You're not getting around it, but you could lay off getting an iPhone for another year or a car, right? So that's why we're seeing like a lackluster growth, because I still think the economy is not in the strongest place that it was prior, but we're just seeing the parts of the economy that are proving to still remain resilient. Obviously, again, a lot of the tech stuff, she's going to mention Meta here in a second. Meta is another really intriguing one. And I don't think even Meta trading at a 30 times multiple is that expensive, because throughout Meta's history, it isn't uncommon for Meta to get up into a 30 to 35 times multiple. Like, it usually likes to peak around 31, and then the stock price pulls back a little bit, and then it continues to kind of go up. But I mean, you look at this last, earnings growth, which was just absolutely bonkers. And, the multiple came down a lot. So, I mean, if Meta is able to cut enough costs, do enough things to bring that earnings multiple back up, Meta's not really that expensive here. It's just not. So, I mean, you can kind of understand that, like, tech is still within a very intriguing place, depending on what tech you're looking at. Like he mentioned, like, you get rid of Tesla and Apple, and the rest of these tech companies actually look still very enticing, right?
So let's talk about a couple things that already we've heard. One is Joe's getting nervous. Look at Meta. Meta is the sort of name that makes people nervous who don't own it.
Meta's up almost 4% today.
I wouldn't use the word nervous.
And it is, well, sorry, but I did already.
I would. Go ahead.
It's so close to its all-time high. I mean, people are saying better scramble and buy some because we haven't owned any, and just run and catch the train. And I think that expensive is not a term that applies the way sort of traditionally one would think of stocks. NVIDIA, people talked about it as being expensive. It turned out it wasn't expensive at all.
Do you know how much NVIDIA is up over a week?
12%?
14.
Okay. So, but on a PE basis, and we don't own it, but on a PE basis, it's not that expensive. It's less expensive than, all types of names in industrials you could come up with. You could say that Google is not that expensive, and Meta isn't a particularly expensive stock. Salesforce on a PE basis now for next year is not that expensive.
Joe,
it's a little bit higher than a market multiple. So that's why people like Joe are saying, whoa, maybe we better buy them.
Because Joe is making a good point about last year, where consensus was just dead wrong coming into 2023, raising the question as to whether consensus is dead wrong in the view of 24. Savita Subramanian, Bank of America, says Magnificent Seven expected to drive Q4 growth. So you're going to get your big earnings growth coming from those stocks, which makes it really difficult to look elsewhere. And yes, she's talking about NVIDIA, Amazon, Meta, Alphabet, Microsoft, and Apple, the biggest drivers of Q4 EPS growth.
And NVIDIA up 12% over the last 5 days. Where's the SMH? Is it the entire semiconductor industry that's rallying? No, it's NVIDIA. For whatever the reason might be, clearly investors, quants, algos, they want to own NVIDIA, and they don't have the same degree about the rest of the semiconductor industry, the same degree of excitement. And I think that's saying something about where ultimately the real growth is. The confidence in growth is with NVIDIA, not with the entirety of the sector.
This is so prudent to understand, because this is what somebody was telling me, like, why would you just own NVIDIA, just own the Vanex Semiconductor? Because I was also talking about Taiwan Semiconductors, right? But I don't think people understand the wave of what NVIDIA has accomplished and what a profound insanity of growth. I hate how they even undersell it in this video. What NVIDIA has done has been a marvel beyond any S&P top 10 tech company's ever been able to do ever, by the way. The growth rate that NVIDIA is having at the scale at which they're doing it is absolutely absurd. It has never existed in the history of ever. And their margins are unlike anything at scale at 75. I think it's like around 75%. So when you go through like the Vanex Semiconductor ETF and you look at all these semiconductor stocks, they suck. They just suck. They're just not nearly as resilient. And I don't know why, because I'm an idiot. I'm not a semiconductor, producer. I have no experience in it. I didn't go to school for it. I can't tell you why this is happening, other than clearly NVIDIA has a product that is just gobbling demand up from big businesses like Amazon, Meta, and Tesla, and all these big businesses that want AI computers. Now, that well will start to run dry at some point. It has to. There's just no way it is sustainable. I keep saying this, but if it is sustainable for another year or two, they will very likely be at the scale of Apple at net income with a lot less revenue because of the margins they're able to pull. You look at something like Taiwan Semiconductors, look at their 2023 month-over-month revenue. It has been negative every month except for the exception of October. Go look at NVIDIA in comparison, growing at like net income by like 50% quarter over quarter. It's absolutely ridiculous, right? So why is TSM, like one of the largest producers of chips, not able to pull the same demand? like what it is with these like GPUs and these just AI chips, man. Like you can just see the differences in business models. And this is something I would have completely missed out on if I held my TSM shares, right? If I was like, oh, TSM's the end all be all, it's cheaper. Yeah, there's some China risk, whatever. But you don't understand like, how dumb people like me really are when it comes to trying to pick these individual stocks. Now you can't obviously just buy the VanEck semiconductor ETF. Personally, for me, I still think the best thing is just the S&P 500 because you're just getting the best of the tech companies weighted at like almost 30% of the whole thing, right? So just it kind of waives some of those factors. And then again, as I try and hand select, being my stupid self here to see if I can outperform is questionable, but we're going to damn well try with me obviously buying some Google shares. But we'll just finish this up quick because there's a lot of other cool stuff I want to get to here.
Semiconductor industry.
Oh, that was the rest of it. Okay. Huzzah. Huzzah. Okay, well, here's what I want to show you guys. Let me cancel this out real quick before it starts playing another video. So what I want to talk about here is let's see if this loads. Come on, load for me, baby. Load for me. Ah, there we go. So there's one more thing I want to talk about when it comes to inflation, but I kind of want to fill some entertainment void in here because I think it's a little bit more relevant because obviously we're going to listen to our favorite boy here when it comes to fun strats, Tom Lee, because he was talking about inflation and why it's likely the Fed's still going to cut. But I really want to kind of just fixate on this AI conversation because I want to blow your minds really quickly here. And I've been getting a lot of funny comments about this too. Let me just see if I can find this real quick. All these, like this guy here saying that all these tech stocks are basically way overvalued. Eventually they will stop talking about this BS AI and it's been around forever. People are just blind. Yeah, I think AI hasn't been around in the way it's been around right now. I think that's quite relevant. Maybe people in Google have been working on it, but they didn't want to jump the gun because, they were working on it, right? But ChatGPT kind of forced this revolution because it was just something that took the market by storm. And I just want to show you a little example here because I think, again, this might be a little over exaggerated because there's a lot of personal art interpretation in this, but it is mostly AI generated. And it is the comedy special of George Carlin. If you have not seen this, this is one clip, but you got to watch the whole thing because it is just like mind-boggling. But just listen to this. This is like the coolest shit I have ever seen. And this is going to really put into perspective how AI is going to transform a lot of shit in the next 30, 40 years.
There's one line of work that is most threatened by AI, one job that is most likely to be completely erased because of artificial intelligence. Stand-up comedy. I know what all the stand-up comics across the globe are saying right now. I'm an artist and my art form is too creative, too nuanced, too subtle to be replicated by a machine. No computer program can tell a fart joke as good as me.
This is insane.
Well, let's see. This is just off the top of my artificially intelligent head. A fart was in the middle of a very nasty divorce, so she went to her sister's house and she asked her sister, "Do you think I'm doing the right thing by getting divorced?" And her sister said, "He's been holding you back for too long. You have to leave that ass."
Oh, shit, dude. Snap.
Yeah.
Look at that.
There you have it. Stand-up comedy is dead. Literally. I might be the first stand-up comic to be brought back from the dead by AI, but I certainly won't be the last. Richard Pryor, Joan Rivers, Bill Hicks, Robin Williams, Dick Gregory, Andy Kaufman, Moms Mabley, Sam Kinison, everybody's coming back. And we're all going to have our own 24-hour-a-day, 7-day-a-week, 365-day-a-year streams commenting on everything that's happening in the world as it happens. AI resurrected stand-up comedians are going to be the news anchors of the next decade, which, God, dude, now that I think of it, means news anchors are probably out of a job too. And I know that some people are going to be against that. Some people are always going to want a real flesh and blood human being observing the world and telling jokes about it. And I get that. I really do. But if you can keep an open mind, I think I can make a case for at least one comedian we can all agree is better in AI form. Bill Cosby.
This is like one of the most jaw-dropping examples. There was so much drama about it with George Carlin, his whole family. I think his daughter came up or whatever, and she was complaining about this because they said he wouldn't agree with this. But this is so in kind to his likeness that it is damn and just insanity, considering the entire scripts are mostly AI written. The entire voice was completely AI regenerated. I mean, this is the true nuance of what we're going to see unfold. And I think it's a bubble. Like I said, I've stated this before, and I've been arguing this with people in my chat groups. Thanks to those people that were supporting on Patreon. But I just want to point out that AI today is like crypto was during the boom, right? There's so many AI tech companies that are trading at way too high valuations. But when you look at companies like Google, you know, like Microsoft, and you see this stuff, ChatGPT, all these things kind of accumulating together, like Adobe Suite software, and you see how this is playing into editing software. Right now, it's an extension of human creativity. Like this video here, this video couldn't have just been a one-click generated AI video. It wasn't going to happen that way. But the fact that these tools exist where someone can recreate these things is just that first stepping stone and into that idea that this is how, you know, infant AI is going to be. This is the most infant you're ever going to see it. And it is only up from here. And I mean, if you go back to the early 2000s in the dot-com bubble, and everyone's like, tech's going to be the future, and we just didn't know how before the iPhone even existed. I mean, that's AI, but I think it's way further ahead than tech was even during the tech bubble. So like I said, you just got to be a little careful with some of the stocks. But when you're looking at big tech companies today, I just don't think people understand this is software. And I stated this, and I'll state it again, man. Software is going to be the leading contributing factor to the massive weight of returns. And we're seeing it in the Canadian economy. We're seeing it in the US economy. You look at the balance sheet comparable between even Tesla and Apple and comparable to just software companies like Microsoft and Google. And it is almost jaw-dropping at the vast differences that I think are going to continue to echo into the future, because the past tends to continue. Like, it's that whole idea of entropy, right? Like when something gets in motion, it's very hard to slow it down. And I think people keep saying tech's over, tech's over. They've been saying it forever. It's finally had its run. I've been hearing that ever since I bought Apple when I first started investing. You know, this is all peaked, it's done, it's over. I just think we're still in this infancy of this massive leap into this once in a generational, like, you know, infrastructure shift, right? And this is, again, this kind of repetitive AI Kathy Wood conversation about like how long it took to go from like a printer press to a steam engine to this to that. It took like 50 years and like 30 years for all these mega jumps to happen, right? But now we're like every 5 years, there's like every year realistically, there's like a mega jump happening in an industry, and it's disrupting quick, right? So it's just something to pay attention to, and it's a fascinating conversation. I think too many people today are caught up in the traditional stocks. Like when I see PPCE and buying things like MO Group, my heart sinks a little bit. When I see people just looking at these option ETFs, my heart sinks a little bit, because it's like, if you are a young person and you have such a long road ahead of you, to ignore this such simplistic idea that is right in front of your face, that these companies are not actually that expensive. These companies have an incredible amount of growth ahead of them. We're still in this rocky market environment where when they start interest rates, yes, the dividend and infrastructure companies are going to have a nice comeback, but they are still never going to have the comeback these tech companies are still going to have, because when interest rates get cut, people have more spending on marketing dollars, they have more spending on tech to build their businesses, and it's all going to continue to flood into these big companies, as it has in the past, as it will into the future. As monopolistic as society already is today, it's only going to get worse. It's just the way the economy and big business works, right? The rich get richer, the poor get poor, until we head into, you know, an inevitable, you know, who knows, maybe we get into another civil war. I don't know, hopefully not in my lifetime, but that tends to be the way society trends. You know, too few get too much. And again, I don't want to say it as a company, because I was arguing with some guy. He's bitching that these companies shouldn't have this much money, but I'm like, you know, companies are held by people like you and me. It's held by retirement funds. It's not like some one guy is controlling the whole system, right? It's not like Tim Cook is controlling everything. He can be voted out of Apple at any time. So do keep that in mind. It's not like there's some oligarch, one dude controlling the whole puppetry. It's a lot of self-interest in between here, right? It's a lot of, and I'm going to get into the self-interest conversation. I've been having if you watch Sandy Monroe, I want to bring up the auto industry in a sec, because, oh my God, there's so much intriguing business to learn in the auto industry right now. But listen to this.
Tom Lee and MUFG head of macro.
Oh, come on. Don't lag on me now, baby.
Strategy, George.
Did I just pause it again? Oh my God. If we have to lag through this, we're going to have a big problem tonight, folks.
Goncalves. Guys, happy Friday.
Oh,
good to see you.
There we go.
Tom, the Russell 2000 was lower today, and in tech, even stability seemed to be in favor. Microsoft was higher, Meta doing nicely, IBM, Oracle. What does this week sort of ex-Bitcoin, we'll get to that eventually, what's the meaning of it for what you expect in January?
Well, we're 2 weeks into the year, and this week certainly feels defensive. I think investors are still debating whether or not this is going to be a market where the Fed is supportive. I mean, we had some comments where, you know, we've got some inflation reports, some confusion, and some uncertainty about whether the Fed is going to be sort of supportive market making cuts. I think January is kind of a microcosm of what the year is going to be like. I think it's going to be a very challenging year for investors, but and our call has been that you make most of the money in the second half. So I think this is what January is reminding us of, that, we're going to be a little anxious about the Fed in the first half.
And George, what's fixed income doing right now? I mean, valuations, as you point out in your notes, are kind of tied to that quite a bit.
Absolutely. I mean, the bond market's not confused. It's made up its mind that the Fed's going to cut rates. We had the 2-year note basically move almost a quarter of a point, 25 basis points nearly this week. I mean, the curve is starting to disinvert. So we're having short-term rates moving faster than long-term rates. Even some long-term rates are going higher slightly. But by and large, this has been a week where the curve is re-steepened. Rates are lower. They've been low all throughout this whole period. And yet, we had some mixed news on inflation. But by and large, I think the bond market's made up its mind that the Fed's going to cut pretty aggressively.
And Tom, when you look at this week's data, particularly inflation data, CPI, you don't read it as being hot the way some others do. And maybe the PPI data that we got today supports that, right?
Yes, that's right, John. Core CPI, which was reported yesterday, came in at 0.3, and I think a lot of folks kind of zeroed in on the super core number coming in at 0.4. And what we pointed out was auto insurance is over half of that rise. So if you took out auto insurance out of core and super core, you'd be close to 0.2, which is basically at Fed's target. Auto insurance rates are rising because of loss severities over the last 2 years. It has nothing to do with the Fed keeping interest rates here, and it won't benefit from the Fed keeping rates here. It's really because car prices surged and auto insurers have to make their money back. So I think it's almost a statistical residual inflation number, but it's not really predictive.
But George, what would it take for the Fed to actually message that way? It seems like they just got off of the position of trying to convince people that they still might raise rates, so they're still hesitant to indicate any readable inclination to cut.
Look, they pivoted pretty quickly in December. We have a March
cut.
I think we've had it since.
We can pause this here because, again, I think this is going to be the conversation of choice leading up to whatever the first interest rate cut is. And I honestly, we've heard two sides of it. Tom Lee and this guy are insanely bullish that there's going to be an exponential amount of cuts going on, whereas you got Steve Eisman, the guy from The Big Short. We discussed that in the last live stream, who said that he's a little bit more bearish on the cuts because he doesn't want to make the same mistake I think Tom Volcker did and start lowering them too quick too early, and there's no reason to not take it slow when the economy is proving to be very strong, right? So this will highly dictate what happens to your dividend stocks. I think we can get a good rally to some dividend companies this year, but I still don't think it's going to be anything like tech is going to be. And again, it's going to be variant on the tech, but I still think, there's only really one good place to be in this aspect. And I want to kind of pivot a little bit into some of these Q&As here because there's a lot of good conversations going on. And I also, I always want to come at everything into the future now. And I've kind of, I've talked about this with my wife, and I said, working a job and working for so many different companies and, just seeing this in every industry right now. And I think I was really solidified when I just watched that last video on the auto industry when it came, just when this guy was talking about Tesla and just talking about how you have the unions playing into most auto companies, which is why over 50% of dealerships will not sell EVs because they need to make money, right? And that's because of the self-interest of the unions. And it's kind of, it's an inevitable bust. I mean, there's so much self-interest in so many industries. And I always just find it interesting now that I'm always asking myself, I'm not concerned with what the company's doing anymore as much as I am, what is the self-interest of the CEO? What is the self-interest is he trying to gain out of it? Because you look at a company, and again, I'd love to buy Tesla at the right price, though I do think it is expensive. I just think it's really relevant to look at the culture that Tesla has inspired because of the self-interest of Elon Musk, right? He isn't the same kind of, capitalistic oriented kind of a guy as much as he is about, creating certain things. And that culture within the community is we are in a culture to fail. We want to create things that can fail. Whereas, in certain auto industries, you're better off not failing. So just say no, and you'll work your way up the ranks because if something fails, it costs money. The unions get pissed. All these people's retirements and pensions get screwed over. So you just kind of see how self-interest plays up the ladder. And it's a fascinating conversation to be had, man. I'm telling you, if you want to learn how life operates, just ask yourself, what is this person's self-interest, and feed into it. I figure that's the best way to get ahead in the world is figure out what that person is after and just help them get there, because it's the easiest way to stepstone your way up instead of trying to, rub against them or compete, right? And again, this is why, people are putting the valuation they are on Tesla, because the only companies right now that are competing with Tesla are Chinese companies that are actually winning at it. It's a very interesting conversation, I think. All these tech stocks are way too overvalued. That was one of the comments we just looked at. I want to get into some of the new ones here. What about the spot Bitcoin ETF? Damn it. Do research, stay out of these ETFs, buy quality blue chip companies that provide services that you really need. So actually, I want to just anecdotally finish up with the point of this video, because I think he does mention the spot Bitcoin ETF toward the end of this, and I think it's very relevant, actually.
July of last year, our view has been that U.S. cannot afford high rates, and they're very restrictive. Let's be honest, 5.5% is very high in the U.S. You got to take rates down to the threes, and they have to start soon. So it's going to be the setup. Is it going to be a macro force, or is it going to be a combination of a macro force along with some sort of financial turbulence? If it's purely macro, the data has to really decelerate even further than we got this week. In February, January data comes out in February and so forth. this Q1 data can be very weak. Give the Fed the excuse to start the cutting process, and then watch and see how the economy reacts to it. So we're of the view that it come by February, there's a lot of revisions in the data that it might actually revise down a lot concerning the birth death model of the NFP data. Inflation comes in lower. They have all the information there that they'll need to cut in March.
Okay. Now let's talk about Bitcoin. Tom Lee, we got the approval of the spot Bitcoin ETFs this week. Big up day on the first day, down today. I think for the week, about even. Is this ETF party that's now begun going to significantly change the way Bitcoin trades from here?
I mean, it is only 2 days in, John. So to me, I think it's going to make a huge difference because instead of having to go to an exchange and then worry about your private keys, many investors can now use traditional financial markets to access Bitcoin. There's $150 trillion of household net worth just in the US. I mean, allocating just 1% into crypto would be $1.5 trillion of inflows. And that's already more than Bitcoin's network value. So I think there's tremendous potential. And I think it's a really important diversification for a lot of folks that have exposure to US dollar assets and equities or bonds. And Bitcoin is really a good hedge against a lot of monetary risks.
So I just want to highlight this really quickly because I find it so insane right now what's going on with the crypto market. And don't get me wrong, I'm speculating on crypto. I don't talk about it. I don't want people to speculate on it because I've gone around this a few times right now, and I've always come back to this conclusion that Bitcoin is becoming so much more like gold than it should be. And everybody keeps saying that it's not gold, it's the new gold, it's all this, but it was supposed to be a decentralized asset that was supposed to make it easy to transfer currency and all this crap. And it has become nothing of what the original intentions were that were on the original white papers. And now it's basically gold. And how has gold performed? When we kind of start looking and viewing Bitcoin as gold, I think it just becomes a wasteful asset to own in the first place because I don't want to own gold. So, I know people love it. I know people hate it. I just keep coming back to this conclusion that Bitcoin is becoming more and more like gold every day. It's becoming more and more centralized every day. And everybody is just constantly changing the narrative of it. And yeah, you can make some money on it, but are you really going to park your money in a non-productive asset and presume it's a hedge against the US dollar? Okay, then why not just buy gold? Why not just buy some precious metal? Because they've been touting that the US economy was going to collapse and the US dollar is going to collapse for the last 40 years. And they've never been right. And they've always underperformed the market. Go talk to Peter Schiff. I'm sure he'll just repeat the same shit he's been saying since the dot-com bubble. It just never changes, right? A broken clock is right twice a day, man. It's just, you kind of got to get over the fact and look at more productive assets and try not to get caught up, because I see a lot of people in our investment group that are buying and chasing it now. And it scares me a bit because it's what a lot of people are doing, right? There's nothing wrong with holding a percentage of it, but you have to understand it is truly a gamble. It's probably going to become very cyclical. If not, it's cyclical at all, actually. I honestly don't know what it's going to do. I just don't. I appreciate some of the things like Bitcoin Cash, but I like the utility of gaming cryptos and stuff like that, and they just haven't gone anywhere. So why is everybody losing their minds over this ETF when already there are Bitcoin ETFs in Europe, in Canada, in many countries? This isn't a new thing. It's an old thing. It's already existed. The US is just so deplorable in their own self-interest of shit that everyone's like, the microcosm of the US is the only thing that matters. Been able to invest in Bitcoin ETFs, spot ETFs here in Canada for what? A year and a half now, 2 years, never changed the price of Bitcoin. It is purely a perception-based asset. Purely perception. If you think it's going to go up and you're going to buy it because it's going to go up, then it's going to go up. It's a self-fulfilled prophecy, just like kind of like gold is, in my opinion, right? I just feel like there's no rhyme or reason for it. But I do have a few questions that I want to get into here that I don't want to shy away from just yet. So let me see if I can find these real quick and bring these back up because I think they're very relevant here. What's the best Canadian equivalent of V, a U, a G? So for those looking for like Canadian growth, and I don't recommend Canadian growth at all because Canadian growth is largely scary, garbage, and terribly overpriced because there is the growth index. Honestly, I think if you want good Canadian growth, there is a BMO low volatility ETF that I like a lot. It's very expensive. We'll talk about it in a second, but you can look at the iShares Capped Information Technology ETF. This one's actually performed exceptionally well, but the more I dig into it, the least I like it because Shopify is one of the biggest proponents. I think Shopify will be a huge company in the next 10 or 20 years, but it is excessively expensive today. And I have a hard time wrapping my head around it as much as I think Google and some of these other companies are just better investments today. Constellation Software is the most overvalued company I've ever seen in the tech industry. I can't wrap my head around that one. But software business, I mean, what are you going to say, right? You got even things like OpenText I've discussed. The funny thing is BlackBerry's in here. I mean, you can skim through this, and if it's something you like, great. But I honestly think it's just largely a crazy expensive ETF incomparable to U.S. tech companies, right? But if you do like growth, I think you should be looking more toward this staples. There's the BMO low volatility ETF, and I think it's the Canadian one. There's a U.S. one as well, but I actually really like this ETF. It's a little bit more boring. Let me see if I can find it here for you guys really quick. quick. There it is right there. The BMO Canadian Low Volatility Equity ETF. I love the holdings in this ETF. I don't like the excessive management fee, but it has performed pretty well here. Why is it not loading? Is it going to lag on me here? There we go. Come on. Load up, baby. Why are you so dead in the water for me? I'm going to have to pull this up on Yahoo. Let me refresh it here and see if it's going to work. Why are you broken? Let me just pull it up on Yahoo. Canadian BMO Low Volatility ETF. Come on, work for me, baby. Low Volatility Equity ETF. Is this going to work for me? Yeah, I really want to show you guys this because I think it's one of the coolest like weighted ETFs I've ever seen because it's just taking into consideration some of the lower. Oh my God, what is going on? There we go. We're into this. So the dividend you're getting is about 2.68%. Actually, the management fee is lower than I thought it was. For some reason, I thought it was higher than this, but 0.35 is still pretty high. But when you take a look at the holdings here and you take a look at the performance of the stock, it's quite impressive because you got things like Loblaws, Metro, Hydro One, Empire, Waste Connections, Thomson Router, Fortis, Amera, Intact, TMX Group. I think there's much better valuation in here. I think there's much more staple-based companies. I think the ticker on this is ZLB. Let's just take a look at the stock chart on Google here because I love this ETF. Never bought in it. I just admire it from afar right now. But you take a look, year to date, it's up 0.65%. 5 year, getting 38% plus the dividend. But the more you zoom out, it just kind of takes away a lot of the volatility. I mean, the 10-year almost return here, well, I mean, it only goes back to what, 2011. Let's take it from 2014. You're up about 107%. So you're doubling your money in a decade. You're getting great dividend growth. It's the only thing that turns me off is that really high expense ratio, because that eats into a lot of these returns. But what I think you can do is just look at it and perhaps to some degree try and replicate some of it, because it holds such great companies. It gets rid of the headache of watching the market go up and down so dramatically, and it just stabilizes a lot of the Canadian economy outside of what people are used to buying. Because a lot of these companies have performed better than the banks have as of recent. But you can pair it with some of your bank stocks too, right? Which leads into another really interesting comment that I saw that I want to highlight here. This one's fascinating. So this guy made a good point, right? He said, keep pushing the big banks. You can't lose. Don't believe me? Look up bail in legislation. If our tyrannical government wants to fight, which if you guys didn't watch the video, the Canadian government is going after the financial sector, primarily the banks, and they're coming down on them with like a hammer and gavel. That's really going to eat into a lot of their returns to a fairly significant extent, like to a multi-billion-dollar extent on annual taxes and shit. It's pretty bad. And let alone, making them, and I get it, cutting some of the fees that are kind of, attacking the broke people in the economy when it comes to NSF fees. I'm like, can you imagine? I mean, think about it. You used to be able to use your debit card, and if you didn't have any money, it'd be declined. But now you can go negative money in a savings account, and they charge you a non-sufficient fund fee for it. How predatory is that? It's freaking hilarious. But anyways, this guy goes on that the taxpayer will foot the bill. This is all smoke and mirrors to make it look like they care about the little guy. How do you think the banks will handle these changes? Basically, they will close branches, they will lay people off, they will provide shittier services, and more people collecting unemployment, less tax revenue, more reliant on the taxpayer funds. We don't win. Government does. The big six control 95% of the sector and all cover under this bail and legislation. Nothing more than a desperate government looking for more money to fund their failed social projects. At least some of what they are doing is transparent. And I think this is a beautiful comment. It's kind of like when these companies get so big, like Apple, where they kind of rip that company off for their O2 or O3 or whatever the oxygen meter is on the watch, and they got banned in the US. They were banned for a day. And then Apple went into court. They did something that allowed them to get over it and continue to fight it in court, but keep selling it in the US. And it's just kind of funny, how fast these big companies with all this money can control a lot of these policies and these narratives, right? So it's something to pay attention to, because it actually was a really good perspective, I think, because I kind of overlooked it, and it'll be neat to see how it plays into the future of their earnings. But Kyle, you seem well educated when it comes to analyzing companies and balance sheets. That is debatable. I am looking to go back to school to further increase my investing knowledge. Which courses would you recommend taking? So first and foremost, I am a clown. I went to clown college. I was in the entertainment industry for more than 10 years until the pandemic took it away from me. And then I fell into this entertainment industry where I can still be a clown and still make lots of money talking about stocks. And I want to make a really uneducated point coming from my perspective is, what is your end goal? What are you going to school for? I mean, if you want to become a financial advisor, go and just take the courses that require to do it and try and learn from talking to CEOs, because there is more to business than just a balance sheet. As we've learned through the pandemic, just because the numbers are going up doesn't mean cyclically that's the way the business is going to perform into the long term. Just because companies are expensive doesn't mean the stock's not going to go up. Look at NVIDIA. prime example. I mean, you have to understand that investing, and I get active management. I think people are a little ignorant when they say you shouldn't pay a manager or a mutual fund. If you don't have the time to manage, if you don't have the time to understand things and you're getting to retirement, I mean, dividend stocks are not necessarily the end all be all to a retirement. Like my parents, I wouldn't feel comfortable with my parents putting all their money in the S&P just as much as I wouldn't feel them comfortable putting all their money in dividend stocks. You have to manage it because they have to live and pull income. They need fixed assets in case a black swan event hits, and they have to pull capital gains off, but they can't for a good few years. I mean, you need active management to some degree. So learn the best that you can about all these different assets and bonds and GICs and how to balance a portfolio based on time horizon and age and help people understand growth and learn from companies, talk to CEOs, because you ain't going to learn that shit in a book. I mean, I'm just telling you this right now. I've done very well, but it's not because I learned it from books saying like, oh, this is going to work the best. It's a very broad discussion that is very personal. It's personal finance. So you need to understand the broad perspective, right? And I think you can learn that without a lot of schooling, but you need the degree to teach people. So focus on what you want to do, man. If you want to become a teacher and you want to become a finance advisor, then do what it takes to get that and try and learn it from other people because you ain't going to learn it from a book. Tesla will not get down to $100 ever again. As somebody that wants to buy Tesla at the right price, never say never. Stocks can always go lower, baby. If it gets back to $100, I've actually got a video set up. Believe it or not, for the last year now, ever since Tesla hit the $100 the first time, I made a video. I never posted the video, but I have the video ready and I'm waiting because if it ever goes back down, it's going to be the most ironic video I've ever made. And I'm very much excited for it, though it might never happen. Might end up just deleting it. But God, that one's been sitting in the roster for eons. I added a decent amount of income to my portfolio through covered calls personally. I know when it comes to income, though, I mean, covered calls I get, there's a few good covered call ETFs, but at the end of the day, they find me one that outperforms the S&P because that's the thing. I mean, it's killing me inside that my brain is going back to outperformance, and I see it in my wife's portfolio, and I look at my portfolio, and I like the indexes, and that's where all my money is probably going to end up going at the end of the day. But like, I can't help but be like, tech companies, goddamn tech companies. How do you avoid them? I'm like, I want to buy Canadian banks and dividend stocks, but it feels dumb. Everything else feels dumb to Google, to Microsoft. I mean, how do you avoid that shit? Even if you overpay for it today, in 10 years, are you really going to regret it? I just have a hard time believing it. But again, I'm not putting all my money there, right? You just got to be very cautious because I'm not a financial advisor. But I mean, we'll see how this pans out because I'm an idiot and a clown and I'm at least posting it publicly. Damn it. Roger that. Dividends versus growth. I rather have growth. Again, this comes back to the PPC conversation. I see so many dividend investors that want to retire early and they think dividend income is that end resource where they're like, look at the compounded growth. Look at this shit. Look at that shit. It's like it all comes down to the balance sheet, though. At the end of the day, it comes down to what is the future of the business? Because like I said, balance sheet doesn't mean everything. And what are they doing now with their margins? Like how much margin do they have in this business? Because if they can expand the margin and expand the business in perpetuity for the next 10 or 20 years, I'd rather own that business than just a company like MO because it pays a dividend. MO has been going into the toilet for eons. Like, I just can't get over like these dividend investors and they're like 8% yield. It's like that 8% yield means nothing in 20 years if the business isn't going to be sustainable, right? And same with these covered call ETFs. Like they just don't have the same kind of oomph that a lot of these tech companies do. Any advice to someone just starting in a TFSA? I don't know. This is a hard one, right? When you're starting off with your TFSA, and you're new to investing, man, it really just comes down to your personal perspective, your time horizons. Like, I mean, at the end of the day, and this is just my perspective, if you're making a lot of money and you have a full-time job, try not to pick too many individual stocks because you're not going to have time to manage it. You're going to miss something. If you're buying NVIDIA and you're getting these huge gains, and just like Tesla, you kind of started buying it when it was more toward the top, and you start missing that, the financials have changed, the market has shifted, you can get these really wicked downtrends where it can take a decade for those stocks to recover, right? And you don't want that kind of stuff in your TFSA because you only get one go at your TFSA. If you lose money, it's gone forever. That tax-free growth is eviscerated. It's probably one of the most painful feelings you'll ever have. So try and focus more toward ETF growth and things that aren't maybe as managed by you, that have a bit of a back history toward them, like the Qs, maybe like the S&P, and don't focus too heavily on Canadian stocks. It is the biggest mistake I see so many investors make. So many Canadian investors, but mostly Canadian companies in your TFSA. My TFSA has 170, how much? I think I have $171,430 worth of tax-free room right now because I mostly had tech companies in there. So just respect the growth, right? Because I don't know too many people. I know people that are in their 60s that don't have the tax-free savings account room that I have. And that wasn't from taking on major risk. It was mostly Apple, Microsoft. I own the same companies that most people still do, man. It wasn't like I was that risky in my TFSA either. It was mostly just a handful of Canadian companies and the best tech companies, and damn, did it ever work to my favor. VFV, yeah, these are good ones too. Yeah, these are a great start. That's a really good recommendation. Like VFV, HXQ, VDY, they're not bad at all. Wait till they fire up on the money printers. Jealous. Thanks, man. Yeah, always appreciate it. Best thing you can do is hold US dollars and get out of CAD. I really like that perspective, my man. There's one thing I can teach anybody. It's go where the growth is and try and get your currency in that value, because man, oh man, look at VFE. Like, let me just pull this up real quick. I think VFE is the prime example of how dominant the US dollar is, because you see it in this ETF, because it kind of auto converts the currency into the stock price for you. So this is the same thing as holding the S&P 500, but in Canadian dollars. And look at the difference in growth, right? If we look at the max chart from 2012 to, like, I mean, we're just over a decade here and you're up 362%, incomparable to VOO. Now, keep in mind, if you own VOO, if you convert it at any time over that last decade, you're still getting the currency conversion, but this one's up, what, 20? This one has a longer history. But from 2012, this one's only up 242%. So, I mean, there's such a massive difference between these two just because the US dollar has dominated. So you see that even if you live in Canada, owning US dollars has converted way more return than just the stock value itself, because of how dominant people love the US dollar. So there's a lot more to gain than just the stock price by holding US equities. And I think it's very prudent if you live in any country to understand that. Go to where the most dominant country is. That's another big mistake, right? A lot of people look at Alibaba, and I think China has a lot of growth ahead of it, but the perspective of just US assets changes so much in business and life. I mean, think about how hard it is in China to have a great business and raise capital and expand it. It is so much harder than it is in the US, just because of the perspective of where money is flowing right now. SCHD is decent. Yeah, even still, though, I'm thinking about putting my SCHD position on reinvested halt and start taking the dividends and putting in the S&P. I think SCHD will really flourish when the interest rate cut cycle comes back around. But, those are the companies that I think are very resilient for long-term dividend income. They're great. And I'm going to utilize it. And I'm never going to sell the position. I still want to scale it realistically. But I have a huge percentage of it. I want to scale it back to about 25% of the entirety of my portfolio. Right now, it's like 30-something%. I want to keep it at 20 to 25 and the rest of it into the S&P 500 and more growth-oriented companies. But I do like SHD as well. I was buying PayPal during the latter half of the last year. PayPal, debatable. Any advice? Yeah, we just got to these comments. Gold miners. Gold miners are cheaper and better to own than gold stocks. There's a lot of potential in gold. I think there's a lot of potential in energy. I'll talk about some of those stocks this week. Is Snapchat worth buying? I have no idea. I never looked at Snapchat. Who gives a crap about Snapchat? I added a decent amount of income to my portfolio through covered calls personally. Yeah, we got to these comments. I'm going to finish up here. Any new comments, folks, before I finish up? Always read a perspective of an ETF to see if it aligns with your investing objective prior to adding it to your portfolio. I agree, because sometimes there's a lot of hidden fees and people complain about it, but you got to be a little careful. When do you think H-Bank catches traction and starts flying? To be honest, I'm kind of annoyed because I don't like our government, because I think what the government just did to the Canadian banks is going to definitely slow a lot of their growth in the near term. I think the Canadian banks now are looking at like a 3-year. So here's the thing, right? I think very shortly we're about to see a good rally in the banks just because of loan loss provisions. I think so long as the market stabilizes here and the quality of these loans start to finish up, and again, we have a lot of mortgage renewals coming up still. It's like this game of cat and mouse. Like, how long before all these renewals come up before we start seeing interest rate cuts? Because that's going to change the quality of the loans, and it's a very sketchy game we're playing with the banks right now. But the long term is they're undervalued. Eventually, the economy stabilizes, and eventually these things are going to skyrocket because they're losing their retained earnings to loan losses. And that is a short-term thing. It is not going to last, which means as soon as they cut off loan losses and they start retaining earnings like Meta did, like the tech companies did, they will have a bounce back. And that's where you'll make your initial jump. That's where the initial return of being like, hey, I bought them at a discount. That was great. Maybe you make an extra 10, 20, 30%. Great. And then the problem comes is where's the growth? Because people do not want to immigrate here like they used to, even though we still have great immigration. People are complaining a lot. Canada is super expensive. People need to come to Toronto and Vancouver where all the jobs are, but they can't afford to live here. The guy that set up our Rogers was complaining. He wants to go back to India. I'm seeing it on the news today. Everyone is going to these freaking food banks to try and feed themselves. They say said Canada isn't what they were promised. So I'm in a very fearful state that we could run into a slump in immigration at some point as well, because the perspective is changing, right? So you got to be careful. Banks are great for income. They will always be great for dividends and income. There's nothing wrong with that, but you can't be holding them as a growth vector, because I just don't think they're going to have the same history that we've had in the past, unless Canada somehow becomes a better place to live for people, I guess. Because I mean, all the growth is immigration, and I'm very worried that's going to stall out here soon. And I don't know how you change that. I could be wrong. I mean, I absolutely could be wrong. We own them. I'll always own the banks, but I'm skeptical of their future the way it's going right now. Companies like BLK, BN, et cetera, will benefit greatly from these infrastructure needs. The government won't be able to fund these projects, and private companies will be there to step in, more than likely. Thoughts on EQB? I don't know. I'll have to take a look. Is there Canadian equivalent to SHD? Yeah, VDY is probably the closest Canadian equivalent. There's also another dividend ETF. I think, what is that? XIU, I think, is the other one. XIU, but I think VDY is better for growth, but XIU is done fine too. Infrastructure. What about airlines? Don't touch airlines with a 10-foot pole. Airlines are very sketchy, scary stocks to own. Shit happens. You saw the pandemic. They're just airlines are just ugh. Again, margin people. I'm going to finish up with one statement here. Margin. Airlines don't have like Nvidia like 75% margins, damn it. They don't have Apple like 30 to 40% margins, damn it. Look for margins and look for software. The only thing you need to care about is margins and software. That is where the money is going to be. It's the only place it's ever going to be. So forget infrastructure, forget utilities, forget airlines, forget cruise lines, forget anything you love about real estate. Forget all that crap. The real money that will make your portfolio exceptionally wealthy in the next 10 years, mark my words on this video, is going to be effing software. Software is going to rule your bloody world sooner than you want it to be. And the only thing that is going to make more money than that is the friggin' Nvidia that's picking those shovels for now. I don't trust it. I'm skeptical. It could work, but I'm all about software. That's why I'm buying Google. That's why I like the S&P 500, because those are the companies that sit at the top of the S&P. Gives me the rest of those beautiful low margin businesses. I love them greatly. They're very sustainable. They're not as volatile, but my God, we know where the money is. We know where it's going to be. Think about it. Stay cool. Stay awesome, folks. Software. Just go look at the AI videos. That's where the money's at, baby. And it's coming like a friggin' steam engine, like the steam engine did come. Peace.